Welcome to the Chartered Financial Analyst Level 1 course. As usual, I provide a small introductory slide about my qualification and experience. We will continue the topic of corporate finance and equity on this video, which is the video number 7. The topic of today will be the capital budgeting, which will be the final video on this topic. In the next video, we'll start the topic number 3, which is the cost of capital. This is the video number 4 with respect to the topic of capital budgeting. In this video, we are going to finish this topic by doing some practice questions and answer. The most important part of this video is how to answer the question, not the question themselves. Let us start with the first question. This is the net present value of an investment is equal to the sum of expected cash flows discounted at which rate? Is it the internal rate of return? The internal rate of return will give us a net present value of 0. So we are looking to the exact value of the net present value, not the rate that make the net present value equal 0. Risk-free rate of return, this is a rate that is being given by banks, deposit, and treasury bills of the US government. We don't use that because this is very low. We should earn a risk premium over the risk-free rate of return, because if I'm going to use the risk-free rate of return, why should I take any project that has risk? I should go direct to the risk-free rate of return on some investment, as I mentioned. The answer number C is opportunity cost of capital. Yes, this is the rate that we are going to use as a discount factor. Why? Because if the net present value I'm going to use is 10% and there is an opportunity that gives 12%, for example, why should I use the 10%? I should go direct to that opportunity and leave the project. So this is the right answer using the opportunity cost of capital. A 2.2 million investment, that is the cash outflow, which we call it the initial outlay at year 0. We spent $2.2 million in an investment. This investment had the following cash flows and the present value. Year 1, normally we start with year 0. Year 0 is always the initial outlay, which will have the same value, 2.2, because we don't discount the year 0 because the money has the same value. After 1 year, then we need to discount to a small amount. So this is the cash that comes in, 1.3. Using the discount factor, we get the present value of 1.2. Here, year 2, the cash inflow is this much, and this is the present value using the 8% opportunity cost of capital. Opportunity cost of capital as a discount factor. We get the following. Is it 2.457, or 3? Closest to. That means the nearest figure. It is so simple. This figure is negative. We add the present value in the first year plus the second year until the end of the year. These will be positive and this one will be negative. The end result will be negative 2.2 plus 1214.15.6. The total is 2.5. This is the net present value, which is 2.5, which is very close to 2.47, and this is the right answer. The next question, the internal rate of return is best described as I mentioned in the previous slide, this is the rate that make the net present value equal 0. An opportunity cost of capital? No, this is the one we use to calculate the net present value. Time-weighted rate of return? No, discount rate that makes the net present value equal 0. This is, I think, a straightforward question. Let us move to an investment of 20,000. We create a perpetual after-tax cash flow of 2,000. After tax is very important, as I mentioned in the previous video number 6, that we always take the after-tax cash, which gives 2,000 every year in perpetuity. That means forever. Just like what we did in the first video in this series of the building that fetched $150,000 rent, we divided it by the required rate of return and we got the value. So equally, the value of the 20% project is giving the cash of 2,000. That means 2,000 divide 8%, which is the required rate of return, will give the present value. These are the answer given. Let us do some calculation. As I mentioned, the present value of a perpetuity equal the cash inflow divide the required rate of return without 1 plus. We normally put 1 plus because there is 1 year, 2, 3, 4, 5. We know the life of the project, but this has no life, endless life. That is perpetuity. So we go direct divide 5, we get the present value is 25. So profitability index, as we mentioned, equal the present value divide the initial outlay. If it is more than 1, that means the present value is more than the 20,000. Let us see profitability index equal the present value of future cash flows, which is 25, divide initial outlay or the investment of 20,000. It is in simple terms. Forget about all this algebra and calculation. So simple. I spent 20,000 in investment. That investment will give me a value of 25. That means my value increased from 20 to 25. So dividing the present value I get by the amount I paid, if it is the same, that means the result is 1. If it is more, that means I will divide 25 or whatever more than 20, divide 20 will give more than 1, which in this case 25,000 present value divide initial outlay 1.25, and this is the answer number C. Question number 5, a profitable investment project has a conventional cash flow pattern. We did mention that conventional, that means you start with negative, that is initial outlay to invest in the project, and then subsequently every year we get positive cash inflow. The unconventional cash flows we get in between negative and positive. Cash flows for the project, initial outlay and future after tax cash flows all double. That means if my cash flow is doubled every year, you would predict that the internal rate of return would be increased and the net present value would increase. Yes, the net present value will increase because you are doubling the cash flows. But return, IRR, internal rate of return, the return is always fixed, even if you double the amount, unless sometimes you double and sometimes you increase by less than double. Then there will be a change in the rate of return. Stays the same and the net present value will increase. Stays the same and net present value will stay the same. No, because the cash flow is getting higher. That means the net present value will get higher. That means B is the right answer. Question number 6. You have evaluated an investment proposal and found that its payback period is 1 year. You remember in the last video number 6, we have 1,000 initial outlay the first year, and then, in year 0, on the first year we got 1,000. That means the payback period is 1 year. But the 1 year cash flow in the future will worth less than the 1,000 which initial outlay. So the net present value will be negative. Payback period is 1 year. It has a negative net present value, which is okay. And it has a positive internal rate of return. It makes sense because the internal rate of return that make it 0. So the net present value is discounted by more than internal rate of return, and this is why it becomes negative. Because had we used the discount factor equal to the internal rate of return, which let us assume positive 3%, then the net present value will be 0. But I can use 10% and get a net present value negative because my cost of capital is 10% and I got a negative. But the project will make a 0 net present value at IRR of plus 3 positive. So is this combination of result possible? Yes, definitely it is possible as I explained it. No number B, no number C. I don't need to read the other. Yes is the right answer. It makes sense. With regard to the net present value profile of two projects, I have two projects. I have net present value profile for them. The crossover rate is best described as, that means if we plot it in a graph, the two projects. Never forget that we are not talking about one project, two projects. When they cross together, that means two projects have the same net present value, two projects have the same internal rate of return, and a project net present value changes from positive to negative. That is not answer. Definitely number A is the answer. They have the net present value the same amount because the graph shows the net present value going down as we go further and increasing the discount factor. So when they cross, that means they have the net present value equal together. Now, let us see a final question on the net present value profile. The point at which a profile crosses the vertical axis is best described as, before I give the answer, I thought it would be better if I put a hypothetical graph to understand the question, net present profile value. The net present value, if we use a discount factor, we get 50 million. If we use more, we get less net present value, less than 50. If we go to 8%, we get a net present value of 32. If we go to 12, we get 22, and so forth. This is a normal curve of any net present value profile. So this is a profile. It goes like this. It starts with discount factor 0. That means we are not discounting it. If I say discount factor is 0, that means there is no discounting. The value will be 50. But if I increase the discount rate, the net present value, which is this column, vertical column, net present value, the value goes down as we go further increasing until we reach the 0 here, which is a net present value equals 0. The rate will be the internal rate of return. Now let us go back to our question. With regard to the net present value profile, the point at which a profile, this is a profile, crosses the vertical axis, this is a vertical axis, is best described as the point at which two projects, we don't have two projects, it's only one project with one net present value. The sum of the undiscounted cash flow from a project. This is the point at which the profile crosses X. It's talking about the point of 50. The sum, that is the amount of the undiscounted cash flow, that is the net present value of a project. This looks the right answer, but let us see the C. A project internal rate of return. No, as I said, the internal rate of return when this net present value curve goes down until it touches on the horizontal line, making the net present value equal 0. So it is not the internal rate of return, it is the sum of the undiscounted cash flows, because we said the discount factor is 0. That means we didn't discount any money because the discount factor is 0. This is a discount factor. So B is the right answer. With this, we come to the end of the topic of capital budgeting. In the next video, we go to my favorite topic of cost of capital. This is a topic that will follow you all the way until level 3, which is very central to the CFA course and to the finance in general. Please do subscribe to the channel so that you receive all the videos together.